If you're trying to understand what's actually moving your portfolio, start with US Treasuries. Not tech stocks and not oil. It's all about the debt that Uncle Sam issues. The real driver has been long-term yields, which have been whipsawing in ways that most investors haven't seen in your lifetime. And because Canadian mortgages, bond ETFs, and even those balance funds all take their cue from the US yield curve, these moves are now hitting closer to home than many people realize. Now, even if you only invest in Canada, you need to realize that the dominant risk-free rate benchmark is still based on the US Treasury market down south. Now, when these long-term yields move, everything reprices, from stocks, real estate, credit spreads, and yeah, even the Canadian dollar you earn. So for both advisors and retail investors, understanding the US yield curve is basically understanding the global cost of capital.
US Treasuries are essentially the global benchmark in the fixed income space and an anchor in the financial system altogether. The US yield curve really gauges the state of the US economic, fiscal, and monetary outlooks. Given the US is one of Canada's major economic partners, any changes in the US yield curve will trickle through into the Canadian economy and our Canadian equity markets. A major factor in currency markets is the rate differential in the front end of the curve. This is known as the interest rate parity. These are only a few examples, but you can see why it's important to understand and observe correlations between US Treasuries and the Canadian investing landscape.
So right now, markets are basically reacting to three forces. The first one is sticky inflation readings. The second one is a high-level Treasury issuance. And then the third one is that we have a constantly shifting expectation for Fed cuts. This combination creates a lot of rate volatility, but this is precisely where long-term Treasuries could shine.
That's right. Let's look at some key drivers in the long-term yields. Firstly, throughout 2025, we saw labor market weakness, and we noticed that economic growth projections have come down and pushed the Fed to cut the benchmark rates. Secondly, the market is pricing in more stable outlook for US fiscal policy. This was deemed riskier earlier in the year, where the US 30-year yields hit the 5% resistance multiple times. And lastly, let's not forget the Fed. Quantitative tightening is coming to an end, and the new Fed chair is expected to come in 2026 and will have a dovish tilt. With that said, there are potential headwinds in the long end of the curve, and that is inflation. Even though inflation is trending lower, it remains stickier than expected and relatively higher than historical averages. This does create challenges to the Fed's dual mandate. As they focus on employment, there are risks that inflation can run, pushing the yield curve higher in the long end. Something to note on inflation. CPI is a common inflation metrics that we see in the news, but there's another one that we want to monitor. It's called PCE, Personal Consumption Expenditures. PCE is the preferred inflation metrics for the Fed, and it captures a wider basket and reflects changes in consumption patterns.
What you might not know is that for many investors, long-term Treasuries can act like a portfolio's shock absorber. For instance, when economic growth expectations fall or deflation hits, the long bond historically has rallied hard. And that's precisely what happened in 2008 during the Great Financial Crisis, and actually again in 2020 during the initial COVID-19 shock in March. It's about convexity, not just clipping coupons for 20 years straight. When markets panic, long-term Treasuries have historically moved quite a bit.
That's exactly right. In such economic environments, we see the yield curve shift lower, and the added convexity on the long end will give you the outperformance you're looking for. Let's take a look at the term premium in fixed income. Typical yield curve will have an upward slope where your long-term yields will be higher than your shorter-term yields. This is because bond investors require additional yield as compensation to extend duration along the yield curve. When entering a recession, the yield curve tends to flatten out and reduce the term premium, and only upon economic recovery will we see that premium increase again. Therefore, you want to lock in that premium before the flattening occurs.
And finally, like many different aspects of risk, rate volatility can actually be a potential source of return. If you're positioned correctly, long-term Treasuries can actually monetize those big swings. That's one of the reasons why investors do look at ultra-long duration Treasury exposure. You're basically gaining exposure to the market's reaction to any macro surprises.
We look at two major risk metrics in the fixed income world. Duration is the sensitivity between bond yields and price. For example, if you take a 2-year bond and a 30-year bond, both have different durations. For a 1 bp change in the yield curve, price change in the 30-year will be larger than the one in the 2-year. Convexity, on the other hand, is the extra price capture a bond investor is exposed to when yields have larger moves. To summarize, The long end of the yield curve is more volatile and has greater price sensitivity, which will position you nicely for potential macro surprises.
So for Canadian investors though, accessing long-term US Treasuries isn't always straightforward. There's a variety of issues that could arise, from currency exposure, picking the right duration, and also having the right product structure. These all matters. And when you're trying to build this on your own, whether by buying individual treasury bonds or maybe even using futures, it's not always practical for most retail investors. That's where something like the Global X 20-year US Treasury Bond Index ETF, TLTX, fits in. It gives Canadians a clean, scalable way to access the part of the yield curve that reacts the most to macroeconomic surprises. And instead of trying to manage duration, roll schedule, or liquidity on your own, you get direct exposure to the long end of the yield curve through a rules-based index in a liquid, brokerage-accessible vehicle. So TLTX tracks the ICE US Treasury 20+ year bond index, which holds US Treasuries with a maturity of longer than 20 years. As we discussed, this is the segment of the yield curve that moves the most when growth expectations change, when rate volatility spikes, or when markets start pricing in deflationary pressure. For advisors, TLTX can help them round out a defensive sleeve in an allocation. But for individual investors, it's simply a more efficient way to express a macro view in a brokerage-accessible vehicle. So whether you're an advisor building a defensive sleeve or just a retail investor looking for additional diversification, remember that long-term US Treasuries can play a meaningful role. They can provide deflation protection, react strongly to macro surprises, and investors can also monetize the volatility that drives the long end in a liquid and affordable way, and that's all due to TLTX.